A small chance that rates could rise this week. Nedbank says it expects the South African Reserve Bank's Monetary Policy Committee to leave interest rates unchanged. That announcement is to take place tomorrow. But the chances, it says, of a hike have increased significantly. Now, of 20 economists in a Bloomberg survey, just over half predicted a quarter-point increase in the benchmark repo rate, and that affects us as consumers. Interest rate hikes make it more expensive to pay off bonds and cars where variable interest is charged, but it could help the economy to cool down if prices are rising too much, and it does make the rand more attractive to foreign investors. Let's discuss. We're joined by Chief Economist at economist.co.za, Mike Schussler. Mike, thank you for being with us. I think it's been such a long time that we've almost forgotten that interest rates can rise in South Africa.
That's correct. In the second quarter of last year, we dropped interest rates to where they are now. And we've had 50-year-long lows in interest rates. And what's also interesting is that the last time they were this low, they were only there for about a month. This time we're now at 14, 15 months, where interest rates are at 3.5%. And I think that's given the economy a lot of time to recover. However, I'm of the opinion that we probably won't see an interest rate because other things have happened, such as load shedding. And for the Reserve Bank, they don't want to add pain to the economy right now, I think. Everybody knows that inflation is above the interest rate and you don't want it there. But this is one of those strange times again where we are having to look after what we have and not just try to look after the rising prices.
All right, so you're not expecting an interest rate hike, but if it came, there would be pain, right? Because many South Africans, even though interest rates are so low, have been affected by all the things you talk about, and there's still a high level of debt.
Yeah, look, South Africa's consumer debt relative to other countries in the emerging markets is not that high. As a percentage of GDP, it's actually on the lower side. It's about 38% or so, whereas the average emerging market is probably around 42% or so. So it's really not a problem compared to our peers. So I think we can go on and leave interest rates where they are for another few months. We will have to increase at some stage. Interest rates are not therefore not going to be low for this low forever, but I do think they're going to remain low for a relatively long time, in the sense that we're probably not going to see interest rate hikes that take us way beyond where where the current inflation, for example, is. We won't have a repo rate of say 5% in a year's time. That's very, very unlikely.
Yeah.
We'll probably only be then at about 4 or 4.5%. So I think it'll be a long time before we see interest rates move substantially up. It will be a long and slow process.
Mike, correct me if this is not a fair statement, but in an ideal world, interest rates should go up when the economy is doing very well, when prices are rising because people are buying so much and there's so much economic activity. But it's often said prices are rising often in South Africa because of external things, because of imports, because of petrol, things like that, not because we're all thriving and shopping.
No, that's right. You've got, Francis, you've got a very good point here. But the point also is that you cannot forever keep savers not earning money and not being able to essentially live either, because the savers in the economy are also needed. And yes, we have a current account surplus now, but on a 10-year average, our current account surplus is probably negative. And if we come out of these high commodity prices, then South Africa will find itself back in a current account deficit. So we also have to look at that, because we don't want to see, people that put money aside for the future be penalized. And that is not the role of monetary policy. It's actually to look after the value of our ability to spend, and that is otherwise known as inflation. And that, I think, is the ultimate goal of most central banks. Right now, however, around the world, interest rates remain relatively low. There is a chance of it increasing in the near future, there's no doubt, because other emerging market banks have started raising rates. I think it'll be a close decision, but I think overall we've got a low consumer debt compared to our peers. Our interest rates are very much in the middle of the pack in real terms. In other words, after inflation, we're minus 1.5. We see many other emerging markets at much more aggressive than that, and quite a few obviously have real interest rates right now as well. So we are very nicely shaped in the middle. I don't think we'll stand out either way, and I think that's also important. And if you go back to what the other part, what you alluding to, is that the economy is weak. That's why I reckon we're not going to see interest rate rises. It's because of the weak economy. But there is a problem worldwide right now with inflation. World inflation is 5.6%. It has been rising, and it is at the highest rate it has been in 13 years. And at some stage, central banks around the world will have to get their hands out and start increasing interest rates. South Africa, I think, is likely to be at the forefront of that, maybe with a month or two or three. But we're not the first. We definitely won't be the first to raise rates. But I think we'll be a few months yet before we raise rates because of other factors like a weak economy. And, there's a supply chain problem worldwide. I would like to see that solve itself, hopefully in the first half of next year, before we see serious rate rises. Right. I can understand one or so or two by the middle of next year, but I think overall we need to get through the supply chain problems and then see how the world goes on. But we've got to see what interest that inflation also stays tame, because inflation is a tax on the poor. It's a tax on consumers, and particularly consumers who can't get wage rises. So your SASSA grant people, the people without jobs, and so on, and that makes their life very, very difficult.
All right, Mike, thank you, and thank you for bringing up the global picture. I was going to ask you how we're affected by what's happening in the US, predictions that rates will rise there. That was Mike Schussler, Chief Economist at economists.co.za.